forum. It's an open forum. We observe the Chatham House rules, and we request the guests to make a presentation for half an hour. Would that be good, sir?
This presentation is rather long, but we can
if
get it done.
Yeah, if we can have half an hour,
Right.
40 minutes, and then there's an interactive section
Right.
that would follow. Dr. Saab today is going to present, his presentation is on the modern monetary theory. So, वो जो कहते हैं लिटरेचर के अंदर एक genre है जिसको कहते हैं willing suspension of disbelief. Economics के अंदर भी ऐसे ही आपको करना पड़ेगा.
Very good.
Yeah, so you'll have to now take off your losses of monetary theory and then look at it. And then we discuss it critically also. So over to you, Dr. Saab.
Okay, thank you very much. Governor Saab has beautifully summarized what I plan to begin with. Currently there is a heated global controversy going on over MMT. Major figures on both sides. It's heating up because Stephanie Kelton is the MMT advisor to Bernie Sanders. So there is a chance that this will actually get implemented. So people are taking really violent shots against it, and most people who are talking about it, criticizing it, don't know anything about it. So MMT says that irresponsible monetary and fiscal policy were the cause of global financial crisis. So obviously those people who were at the helm, Janet Yellen, Bernanke, Alan Greenspan, they are vehemently opposed to this. But of course there was something that caused it, so we have to give some benefit of doubt to MMT. So Janet Yellen, Warren Buffett, Larry Summers, these are all opponents of the theory. Now, I would like to say that last year I started teaching macro, and I took the modern monetary textbook, and I was completely neutral. Actually, I was skeptical about the main claims. And I said, let's study it. There is a very interesting episode in Imam al-Ghazali's life. He says that, I have mastered all of the ulum that exist except for Sufism. And they say that Sufism cannot be mastered by studying books. You have to experience it. So what I will do is I will give 10 years of my life to studying it, and if I find that it is false, I will denounce it to the world. And if I find it's true, then of course I will. So I just, in that spirit, I said, let me study it and let me see if it is true or false. And gradually I became a convert. Everything I knew about macro has been turned upside down. And MMT theory is very simple, very easy to understand, very convincing. So, and this goes back, it's not that this is something that's new, it goes back to actually Abba Lerner, functional finance. One of the key insights is that the government deficit equals the private sector surplus, which means that the economy cannot function without the government running deficit. So the deficit role is not what we are taught to believe, and a balanced budget will kill the economy. This is the well-known finding from austerity, and it's very simple to explain. Let's see. So that's one thing. The government spending is not financed from taxes. The idea that the government needs to raise taxes in order to spend, this is completely false. The effects of taxation and deficits are radically different. It's not that you can, and the opponents of MMT says that this means this is a formula for irresponsibility. You can just print as much money as you like. This is not true. Deficits have effects. Taxation has effects, but these are not the ones that the mainstream theory tells you. So there are many dimensions to this theory. I think I'll skip over this little bit of demonstration to show how MMT works because of the shortage of time. But this model, let's see, maybe I can do it briefly. Suppose you have rural economy, 10 farmers, 40 laborers, and each farmer can hire one laborer and produce 100 units of corn. Now what happens, I'm not going to go through the details, I'm just going to tell you what the model shows, and it's very simple, there's nothing complicated, anybody can understand this model. If you let it be in the standard monetary economy, what will happen is that one farmer will hire one laborer, they will produce something, and the 30 excess surplus laborers will starve. And the effective demand will be small because it will be financed only from the income of the laborers, because this is an isolated village. So first, the income of the laborers is the wage that is paid by the farmer. So the farmer cannot earn any profits regardless of how you manipulate it, because what he pays for his product is the only money that is available to buy his product. So there's no money coming into the system. So ultimately what happens is the economy collapses because there's not enough aggregate demand. So now what you can do, so this is the Keynesian effect, that if you don't run a deficit, then the aggregate demand is very low because it's generated only by the income of the farmers. So what you can do is, suppose the government introduced social security, it just pays out of its pocket 50 rupees each to all of the 30 unemployed workers. Now the government has a deficit of 1500 rupees. Now what can happen, and what does happen, is that this 1500 rupees can be used to buy the farm. This pumps up the aggregate demand. So now the economy produces more and everybody gets to eat, and the government doesn't need to do any taxation. It's this money just pumped in. It results in 1000 rupees profits for the farmers, 500 rupees savings for the private sector, the employed laborers. So where is this? The savings of the private sector plus the profits of the firms are exactly equal to the government deficit. So it means that if you run deficit to zero, then the aggregate savings of the private sector plus the aggregate profits of the firms must be equal to zero, and no economy can function like this. So basically, the government deficit of 2,500 leads to a tremendous improvement in economic performance. This is sustainable. The government just prints 2,500 every single period. It never taxes anybody, and you get a magical improvement in the economy. This is the basic thing, that there is no issue of Ricardian equivalence, that if you run a deficit now, then you have to tax in the future to pay it back. No, the government can run this deficit forever without any, with only beneficial consequences. So now that's one part. Now I'd like to go briefly to the second part of this talk, because I've learned, you see what I'm trying to do, I'm very excited. I have, in 1 year I have completely achieved a revolution in thinking, and now I want to compress this 1 year of learning into half an hour. So it's a difficult job. So I want to go through a brief history of central banking. So the first era was, this is from Charles Goodhart article available at BIS, Banks of International Settlements. So there is a Victorian era from 1840, when the Bank of England was established, to the First World War, and basically the function of the banks was to provide money to the governments for wars. And they also had price stability and exchange rate stability in mind, and the major problem was how to manage this with the gold standard. This was a serious problem. So there were some Victorian monetarists. They developed policies and ideas which are still relevant and interesting, even though they were meant for gold standard economies. They developed rules for monetary policies which were ad hoc. Their major jobs were to prevent panics and runs on banks, and there was a Taylor type rule that they developed, and there was rules for when the central bank should act as lender of last resort. And these are still contain important insights for today. Okay, I'll skip this. Basically, the theory, the important point about this, the big picture that I wanted to make, is that they were based, their theory was based on certain philosophies which were later proven to be wrong. One of these was the real Bill's doctrine, and it was this philosophy that prevented banks from acting in the right way after the Great Depression, which everybody agreed that if the after the Great Depression, that was especially Friedman's idea, that if the banks had pumped in enough money, they could have averted the catastrophe that follows. But the real bills doctrine prevented them from doing so. So basically, wrong philosophies have caused a lot of damage in the past. In the Interregnum, between the two world wars, there was massive confusion in the central banks. There was attempt to go back to the gold standard, which was, and there is a very interesting article on which I have an hour-and-a-half lecture by Aiken Green on Nurske about how the same policies which worked very well in the pre-war period failed to work and had opposite and perverse effects in the interwar period. So they were trying to put things back. It was like Humpty Dumpty fell off the wall. They were trying to put him back together, but it just couldn't be done. Now, in 1944, of course, you had the Bretton Woods Agreement, and the world changed. Now, in the period after the Great Depression to the Nixon-Shock, there was this is one period which you can say that there was massive regulations on banking. This happened in 1933. There was a Banking Act passed, and Glass-Steagall prevented speculation by banks, and there was Federal Deposit Insurance. There was Fannie Mae, which was a very important act. Basically, banks cannot make 30-year loans. The private banks, they're just not equipped to take that long risk. So the US government insured these, and that led to the widespread use of 30-year mortgages, which was massively beneficial for the US economy. There was restrictions on banks, interest rate ceilings, basically preventing competition among banks. So banking became the most boring profession on the planet. There was the 363 rule: borrow at 3%, lend at 6%, and on the golf course at 3 p.m. But boring is also a safe system. There were no systematic crises, no efforts by central bank to control crises. There were no crises, basically. No systemic crisis. There were private banks occasionally flopped, but there was no system-wide crisis for a long time. There's a periodization I'll skip. So there were some, over this period, there were some functions. Basically, there's always been a battle between what the central bank will do and what the Treasury will do. And appropriate functions were delineated by experience. There are some things that central bank is better equipped to do, and some things that Treasury is better equipped to do. And this was basically worked out through experience. And global experience, there are some differences. In Japan, things are different, and in France, things are different. But more or less similar ideas emerged across the globe as to what should be done. Then came the Nixon-Shock in 1971, when the gold backing was removed from the dollar. Now the theory that we learned, and to my best of understanding it's still being taught, even though it was proven false. Basically, the central banks know a lot more about monetary theory than is being currently taught in universities. So what we were taught, and I asked people if they're still teaching the same false theories, and to the best of my knowledge, they're still teaching the same false theories, that the central bank provides reserves, money is determined as a multiple, so there's a multiplier. And actually, the Bank of England published in 2014 a paper saying that this theory is false. And and the banks have known for a long time that this is false. They learned this in 1980s. But somehow or the other, it hasn't made it to the books. Even somebody mentioned that in the central bank trainings at the State Bank, they still teach this theory. So basically, the Keynesian revolution never got launched. Actually, MMT is the true heir of Keynes. Keynes was vastly misunderstood. What he said never made it to the mainstream. There was the neoclassical synthesis done by Hicks and Samuelson, which misinterpreted Keynes to say that it is the money illusion which causes unemployment. And how does money illusion happen? When prices go up, the real wage goes down, but the workers don't know it, so they think that the real wage is still high, so they work harder. And this theory is false. But basically, the Friedman rule was based on this misunderstanding of Keynes, which is taught in the textbooks all over, that you should just keep the reserves growing at 6%. That will mean that the money supply will grow at 6%. This will cause a fixed and known rate of inflation that will eliminate money illusion, that will eliminate unemployment, and that will create price stability, financial stability, and growth. So there was a one stone kills three birds. So in the 1980s, Volcker at central bank announced that he will try and follow this, and he did it. And this failed completely in 1980s. This created the deepest recession that you had seen since 29. The most important thing was that you found out that you cannot control the money supply like the textbooks say. He kept missing the target. He said, I'll increase the money supply by 6%, and the money would go to 9% or 7%. He just couldn't make it. And that's because credit creation is done by the private sector. And it cannot be regulated, especially the interbank market. This is one of the insights of Minsky. The interbank market allows the banks to bypass the central bank. So one of the key recommendations which emerges from MMT is that there should be no interbank market. All reserves that are borrowed by banks should be borrowed directly from the central bank. This will allow the central bank, if this had been implemented, the global financial crisis could have been prevented, in the sense that the banks kept offering more and more risky collateral, and the central bank could have stopped it. They could have said that we won't lend you reserves against this collateral, and that would have prevented things. But on the interbank market, these were acceptable as reserves, and that really... So once this was tried and failed, then in the central banks all over the world, there was a search for a new way to do monetary policy. Somehow or the other, for reasons I don't understand, this did not make it into the textbooks. I mean, I should have been studying this, and it was only last year. So somehow by accident, New Zealand created the new model for the world to follow. And when they discovered inflation targeting, basically Roger Douglas, the Minister of Finance, told the Reserve Bank that you have to get inflation down to between 0 and 2%. They were running at 16%, and they were actually quite happy that we brought it down to 5%. But Douglas said that no, this is not good enough. You have to bring it down to between 0 and 2%. So they invented this discount rate method, which is now followed all over the world. And now the strange thing is that when I came into the MPC, I didn't know that this was the method. I was a textbook economist. I had never seen the real world before, and so this is one of the recommendations that I would like to make, that the people who are coming into the MPC should receive some training on what central banking is all about, because I thought that we were trying to control the money supply by handling the reserves, and I learned in the first meeting that actually we control the discount rate and we don't worry about the reserves. So anyway, New Zealand discovered this inflation targeting methodology, although MMT does not buy this as a good policy. The fact that you can do it doesn't mean that it's good. Similarly, this operational independence business, in 1997, Gordon Brown gave Bank of England operational independence. And actually this has to do with inflation targeting, because see, once you make inflation targeting your goal, then you have to give central banks independence, because if you allow it to be in the control of the Treasury, then you lose credibility, because the Treasury has Ministry of Finance has conflict of interest. They want to conduct more expansionary policy for many reasons, especially before an election. Also, when the national debt is high, the minister wants to keep the interest rate low, the central bank has other objectives. So there is a clear conflict in it. So this is why the call for independence of central bank emerged and became strong in the new millennium. It wasn't important in the past. So actually this question is very complex because there has to be coordination between fiscal policy and monetary policy, debt management, interest rate setting. All of these things are very interlinked. So the idea that we can just make central banks independent, this is just meaningless nonsense. It has to be thought of in much more with much more depth. It's much more complex issue than appears on the surface. So basically, from the 1970s onward, we had financial deregulation, which led to increasing fragility of the banking system. If you look at the chart, this gives you capital ratios which started declining. As soon as you deregulated the banks, they started creating credit because that's their business and that's how they make profits. So as the capital ratios declined, there were increasing numbers of banking crises and also exchange rate crises. So these are the twin crises, and there are many papers, and one recent IMF paper counts more than 300 crises. It depends on how you define the crisis, but basically when you had the MAB, this is Mexico, Argentina, Brazil crisis, then people said that no, we've got to do something about it, and that led to the Basel Accord of 1988, Basel I, which started saying that okay, we have to do something about this, and there was some international standards set for capital reserves. So from 1980 to 2007, the central bankers were in a self-congratulation mode. Alan Greenspan was called the maestro, and the Greenspan put became famous. Basically, he whenever the stock market would decline by 10% or 20%, then he would make sure that to pump money in the market so that the stocks would not decline. And they thought that they had things under control. Bernanke announced the great moderation, that we have tamed the business cycle, it will not happen again. And Lucas said that we have learned how to prevent recessions, it will not happen again. Then it all came apart in the global financial crisis. And Bernanke said that we know how to handle recessions. Friedman taught us, and we will follow his prescription. So this was the quantitative easing. They pumped trillions of dollars into the market, but it didn't work as expected. So the problem is that what shall happen now? As we have seen today, all over the world there is search for new paradigms in central banking. There is turmoil, and the paper that I'm citing says that today the central banks have become philosophers because the old paradigm, just day-to-day operation, doesn't work. Short-run management is not enough. You have to look into the long range to see if there's a cloud brewing on the horizon. There's very famous clips of Raghu Ram Rajan, who at Woods Hole he warned about the increasing risk to the system, and then Larry Summers got very angry with him, and he really shut him up and criticized him, and later on he proved to be right. So basically the point is that all of the masters of the game in 2005, 2006, they were making statements which you can find that everything is good, there's no harm, there's no problem. So, but they all proved wrong. So one thing that we learned is that price stability does not guarantee financial stability. I mean, the Great Moderation, you had very low inflation for a very long time, but that didn't that led to a financial crisis. So we need to manage long-term risks, but we do not know how to do that. So do we need to radically change from the inflation targeting model? This is one of the issues that is raised. So these are the problems that modern monetary theory offers some solutions. But these are not patchwork solutions. This is not that something that we can do tomorrow. Actually, it says that it's a new way of thinking about the world, new way of thinking about the economy. Basically, one of the key insights is that these Bretton Woods institutions that were developed, they were developed to manage the world after the collapse of the gold standard. But these were basically targeting for fixed exchange rates, and they were trying to make sure that they would supply short-term liquidity to countries which were suffering from temporary BOP deficits. But after the Nixon-Shock, the flexible exchange rate model is the suitable one for unbacked currencies. But to manage that universally, you need some universal accords. My article on this appeared yesterday, but it may easily create the misleading impression, it's meant to actually, that I'm in favor of flexible exchange rates. But this is not true. I'm in favor of flexible exchange rates provided that the institutional structure required to make it work is put in place. Just like the IMF and the was put in place to manage the world liquidity after the collapse of gold. So after the Nixon-Shock, we need global agreements on how to manage the erratic performance of the exchange rate. That will happen. One of the key recommendations that is necessary to do on a global scale is to prevent speculative transfers of capital. You want to allow legitimate cross-border investment, but you don't want to allow gambling. And this gambling is what creates the massive amount of erratic behavior of the FX. And this can be done, but there is no will there because the gamblers are in control of the system. So that's one of the key insights. Another key insight is that deficit is not what you think. The governments print money, so they have the issue of sustainability doesn't arise in the sense that you can always print however much money you need. Now, so you need to look at what is the deficit you need to achieve the goals that you want to achieve. So first you have to set out your targets. What are you trying to do? And then you decide how much deficit do I need to achieve that target. And you look at the side effects and try to manage. All of these things are there, but currently we don't have the mindset for that. We think that if I want to provide job guarantees to the least skilled sector, then where am I going to get the money for that? So the Stephanie Kelton says that this is not a question. It's not a question because the government can print the money. The issue is what happens if you print money and give jobs to all of your low-skilled employees. So this is the question that you want to ask. Will it create inflation? Well, to answer this question, you have to do a lot of deep and detailed study. First of all, you have to look at what are they going to produce. So suppose that we can get all of these people who are low-skilled to produce something. And we can get them to plant trees, and we can get them to build roads. That's how Dubai developed. They hired all of our low-skilled labor, and they put them to work in slave conditions to produce their buildings. We can do the same thing, but where are you going to get the funding? That's a wrong question. We are not going to get. We don't need the budget because they are producing output. If you look at the MV equals PQ equation, then if Q is fixed, then if you increase money, then price will rise. But suppose that you pump money in and Q also rises, then there is no necessary impact on inflation. So this real business cycle, which is implemented in the model currently being used in State Bank, assumes this dichotomy between the real and the nominal. And that dichotomy is not valid, and this is one of the central insights of the MMT. So this idea that money is a veil, an increase in money cannot increase output, this is basically wrong, and that's... So, let's see, do I have another slide? I think I'll almost end. Oops, that's not where I want to go. Oh. So basically the key recommendation of MMT is that we should use unemployed resources to add to output. if you the biggest our biggest output gap comes from unemployed laborers. Now, the reason that this is not measured in the output gap that State Bank calculates is because they have never been employed. So the output gap comes, it's an invisible gap, because so the gap is there. If we were to employ them, we could massively increase output of the economy. But since they haven't been employed before, it's not in the data. So your data will not measure this. But there is a huge output gap, and if we pump money into the system in the right way, we can eliminate this output gap. So the key recommendation of MMT is that we should implement a job guarantee program. But it should not be a make-work program. You just give money people to show up like at the steel mill. You have to create productive jobs. You have to make sure that people you pay for are producing something of value. And there are many ways, but there are also many technical difficulties in implementation. Most important is to build infrastructure, roads, house, lay grid lines. There are a huge number of green jobs available. So all of this, as long as we do the productive jobs, print money to hire people to do production, there is no fiscal gap. So when we talk about the fiscal resource constraint, it's not about having money from taxes. It's about how we can utilize resources to produce things. So this is the last slide. So to actually do this, a lot of research is needed. Suppose I hire lots of people and they are planting trees and they are building roads. Now I have to ask, when they have the money, what else will be needed? So for that I need input-output tables. I need to look at what the additional food requirement will be. And I have to anticipate. So basically it's clear that we will need more food. So some of these people who are unemployed, we should make sure that they are producing food. And we look at all of the demands that will come as a result of our pumping money in, and we have to make sure that we are locally able to supply this. So we have to so we have to do a planned production. We can't just hire people and make them do everything. So that's where the real fiscal resource constraint, it comes in production. It does not come from printing money. The government cannot actually employ millions of people. It doesn't have the capacity to do so. So we need to do public-private partnership, which is actually, I think, what has been said recently by Asad Zaman, and that's correct. I mean, we can create jobs, but we don't have the capacity. If I hire 1 million people, they will just show up at the office and go back. So I have to find places where people can hire people and do productive work. One of the recommendations is that you should minimize programs like social. You should not give people money for doing nothing. Of course, there is an issue of supporting those people who are handicapped or women with children. That's a different matter. That's social security. But you should not generally give poor people money. You should make poor people work for money. Okay, I think that's it. Thank you.
Thank you, Dr. I think it'll take time for us to see the concepts in, but I'm sure there are some of our colleagues and friends who are familiar with the MMT, and they can start with their interaction, and then we can take along. Ali, would you like to take first?
Yeah, sure. So I suppose your main message is that budget deficits they don't really matter.
No, I said that they matter, but they don't matter in the ways that conventional macro tells you that they matter. There's no issue of sustainability. The real impacts of deficits are something which are not correctly computed by conventional macro models. So you have to take the real impacts of an account. The idea that some deficit size is good and some deficit size is sustainable, this is a fallacy. The idea that the deficit to GNP ratio should be at some particular level, this is a fallacy.
And on the current account, Dr. we were having this discussion earlier also, so I think for the benefit of the audience also, if you could share your views.
Yeah, so current account is a real constraint, unlike the sovereign currency.
and so the MMT recommends that the government should avoid making liabilities in foreign exchange. So debt should not be denominated in dollars. Now people say, how can this be? Well, this is again an institutional arrangement. This is how global trading is done. Currently the convention is that it should be done in dollars because that's Bretton Woods. Now that convention has to change. Now how can that change? Well, that requires some international agreements, but it can be done. Like currency swaps is one way to start at it. But basically, if I incur a liability in dollars, then how am I going to pay for it? I'm going to pay for it by, I assume that I will be able to export something and earn exchange and pay it back. So now I should tie this means of earning to the repayment. This is the basically musharka idea, that if somebody is lending me something, he should be my partner instead of my adversary. And so there should be something which happens which will generate the revenue which will allow him to pay it back. And the payment should be tied to whatever that thing is, so that way we avoid incurring liability in foreign exchange. This is one of the key recommendations of MMT.
You see, the problem with this entire idea of MMT. Sorry, I'm from the other side here.
Yes, of course.
I like.
Bernanke.
But, not at all. But I like to think the economy in terms
चलो
of.
आपने येलन ने कह दिया जी.
Yellen ne bhi keh diya.
From the perspective of models, there's nothing. MMT does not help me recognize anything because there's so many moving parts. And the way we do macro, the way we are trained to do macro, we have nice models. One of them actually approved by you, the Epochs model.
Yes.
Which
That was before my conversion to MMT.
Which helps you tie down exactly what the path is looking like. You have targets, you have clarity, you have objectives. Whereas the other side, MMT, I'm sorry, it's complete chaos.
Well, I recommend you to go through my lectures. I have 30 of them on MMT. I have recorded the whole set of lectures. It's openly available online.
But that's the problem. MMT in the entire world is just a set of lectures. There is no set canonical model or something which okay, this is what MMT is. It just changes all the time.
No, that's not true.
There is a set model or set way.
I will be happy to come and develop an MMT model, which is an alternative to the FPAS.
जी इसलिए मतलब
Very detailed discussion. Don't you think your criticism of macro models is a bit relentless?
Yes.
If you listen to Lawrence Cristiano, Olivier Blanchard, the leading macroeconomists who have developed who have produced a lot of literature on mainstream macroeconomic models, their stance is that there is a future for DSD models. But on the other hand, your criticism is, I think, a bit harsh.
Well, there's a quote from Blanchard I don't have, which says that DSG models are based on assumptions profoundly at odds with what we know about the real world. So they have also recognized the complete absurdity of the assumptions on which DSG models are based.
He is the pioneer, one of the pioneers.
Yes.
जी इसलिए
So my question is more crude in nature. That yes, the government can print as much money as it want to, so that it could create demand in the economy and employment opportunities in the economy. But what would there be a level where the government would say, yes, this is the max that I can do, because beyond that there would be, as Ali was saying, there may be chaos, there may be too much of inflation. So how to have that balance in the economy?
After the global financial crisis, the US government printed $29 trillion, and there was no impact on inflation.
देखिए but I'm sure you would agree, Dr. Saab, that's an exception, ji, because the entire world is actually producing and working for the benefit of the greenback of the United States. So that's truly an exception. I think we cannot replicate it in other countries.
Yeah, this is true, but similar, and that shows that regardless of that all economists were surprised at the failure of the inflation to respond to this massive injection of money. So this was against the standard theories. But yes, US dollar is an exception, but many other countries have done similar things, not to such a massive scale, but many countries have tried programs similar to quantitative easing without having the results. But as I said, one of the things is that one has to change our ways of thinking, and currently incurring deficits will cause many types of problems. Just if you don't change anything and you start running larger deficits, this will create many types of problems for the economy. But the point is that it is possible to run very huge deficits without causing problems if you know how to do it, and if you have appropriate institutional support. There is no such thing as too much deficits by itself being a problem, because the government can print $1 trillion rupees if it wants to. It will have some effect, obviously, but what are these effects? We can find out, and they are not. The sustainability is a red herring.
So of course, you have repeatedly saying that quantitative easing did not, achieve the desired results. But I think, as far as the containment of an outright recession is concerned, it was largely successful. The episode that we have seen in the post quantitative easing was a kind of contained depression sort of thing. And the second thing I would like to, in defense of State Bank of Pakistan, the paradigm thinking in State Bank of Pakistan is not dictated by this Friedman's dictum of inflation is always and everywhere a monetary phenomenon. Yes, this could have been the paradigm thinking in, let's say, like 15 years ago or something like that, but this is not the case in Pakistan. You can check our SBP research bulletin. We have some articles on this thing, like a skeptical note on monetary aggregate targeting in Pakistan, etc.
Right. As far as the failure of the quantitative easing, it is certainly true that the quantitative easing prevented the immediate banking crisis. Although Atif Mia and Amir Sufi have said that this was done in the wrong way, basically it led to the too big to fail phenomena. They say that the financial system could have been kept working, and while allowing banks to collapse, and it should have been done to create the right set of incentives. In fact, the wrong set of incentives have been given to the banks. They have been told that you can take massive risks without suffering any consequences, and as a result, currently the system is right back to where it was just prior to the global financial crisis in terms of levels of fragility and exposure to risk. So the chances of it happening again are quite high. So that's one aspect. The second thing is that the recession was not prevented. The Great Recession was the huge amounts of unemployment. Even the fact that people are saying that we are now out of it, this is wrong, because actually what has happened is that, and Larry Summers, who was one of the engineers of this GFC, has in a recent paper, he has admitted this. He said that it's although we see unemployment has gone down, it is not because more people are being hired. It's because the output itself, the potential output, has declined from where it would have been because of the loss in the investment. So basically, discouraged workers have dropped out of the labor force. The economy's capacity is not what it would have been. So we're saying full employment, but it's really a pathetic imitation. And in fact, Larry Summers says something quite strange in that. He said that I went through a large number of models, and ultimately we come up with the conclusion that Keynesian policy would have worked.
Sorry. So please go ahead.
My question is when you print money and when you induct in the economy, so what do you do when you have excess of it? So how you deal with the excess cash that when you have unskilled workers and then you started giving the money? So how do you deal with that, the excess cash?
Well, basically, you see, the paradigm, the real business cycle paradigm, is that there's a fixed amount of product, and if you pump more money into the system, the only thing it can do is to cause inflation. But if you pump more money and you get more output from it, you pay the unemployed workers who have never been employed, and you get them to produce something of value, which can be done, then the quantity itself, the GNP, the amount being produced has increased and the money has increased. So there's no immediate implication in prices. What will happen is actually there will be differential inflations. That's intersectoral balances comes in, the linkages, the input-output table. So some sectors will suffer from inflation, some will have excess production and they will suffer from deflation. And so you have to balance your portfolio of production, and that's where the fiscal constraint is. The fiscal constraint doesn't lie in not having enough money to finance projects. The fiscal constraints lie in making sure that you use the resources in a balanced way so that the output increases in such a way that there is no undue inflation. In fact, some amount of inflation is desirable to produce additional capacity in the desired sectors.
Sir, you spoke about the trade, the international trade. Any particular country right now is trading with multiple other countries, and you have comparative advantages in some products. You're importing, you're exporting. And I think some of the pricing that is there, and some of the trading that's happening, the price discovery, some of the interbank players are actually assisting in the price discovery process through which the resource allocations are taking place. And if you're trading with multiple partners, these resource allocation, these pricing decisions in terms of the exchange rate, I think they tend to bring the system into some sort of equilibrium, because if we try to go to a system where we have bilateral swap agreements with each counterparty in local currencies, yes, it is possible. But if we have this on if every trade is it starts happening on a bilateral basis, I think that would actually involve a lot of inefficiency as well, because I think this present system and the international exchange rates, the liquidity providers, the interbank players, they are providing the liquidity or the pricing which actually brings some sort of resource allocation and some equilibrium in the international flows.
Yeah, I agree with you 100%. There is a very nice book called The Failure of the World to Find a Global Trading System After the Nixon-Shock. People got together. Basically, as I said, the existing system for global trade is rotten. It has very, very bad consequences. Keynes had come in to Bretton Woods with a much better system, which would be, there are many, I have a talk on this also, but there are many requirements. One of the things many things that are wrong with this system, but to change the global trading system is not something that Pakistan can do. It needs consensus, just like the consensus that was created at Bretton Woods, and the collapse of Bretton Woods. After that, there has been no consensus on global trade, so it has emerged by default. And the system works, but that's all you can say. And you are right that bilateral trading would lead to many kinds of inefficiencies. There are a large number of proposals currently on the table. Stiglitz has one, and others have proposed on multilateral trading. There are large numbers of them. All of them would be much better than current system, which is highly asymmetric, gives massive advantage to USA, massive disadvantage to the weaker countries. There are many ways to design better systems, but yes. So just saying that this is wrong is not enough, and but on our own we cannot achieve better results except in a piecemeal way. What needs to be done is develop a new set of international conventions for global trade, which are not dollar based, and the world is moving towards that.
Okay, so since you say you're actually a convert to this theory,
On kar lenge taaki everybody hears you.
okay, since you say you're like a convert to this theory and you've said that it'll take some time. So how long do you think that it will actually take, given that if one individual country won't actually be able to change the system, right? Everyone has to come together on the table, and that would be very hard to do. So how long would that take? Like approximate, just like.
Well, if Bernie Sanders wins the elections, then things will move fast. One of the things, but the thing is that the disadvantages of the current system are known to everybody. They favor USA. So China is on board, Russia is on board. Many countries are currently working on creating alternatives to challenge the dollar hegemony. But all of this planning is being done sort of in secret because of it will have massive impacts on global trading, and it will hurt some countries and help others. So it's a highly politically sensitive issue as to which system comes in. So lots of countries are talking about what is done. Central banks are holding talks, and so I think that change is in the air, and especially the emergence of China as one of the biggest parties in global trade, and the euro, of course. These are all ways to challenge the current dollar-based system, and there are a number of different systems that are possible. So I think that change will not take too long to come about, maybe 10, 20 years.
So what you're saying, it resembles to me like a 1943 paper by Kaleski, The Political Economy of Unemployment. He says that there is enough capacity in the economy, and we have toolkit available to ensure full employment, but he links unemployment with political economy and class conflict.
Yes.
So where does this class conflict or political economy fit in MMT?
Yeah, Kalecki is one of the people who is sources for the MMT, and definitely it is true that the capitalists benefit from large unemployment because they get a tame labor force to hire at low wages, and that increases capitalist profits. So creating full employment, which is one of the goals of MMT, and one of the insights of MMT is that this can be done. It is not that you need money to hire everybody, because everyone, as I think the saying goes, that child is born with a stomach but also with two hands. So everyone can do enough work to feed himself, and so we can enhance capacity. So Kaleki's, definitely there is a political angle to this. The capitalists are not interested in creating full employment and prosperity for the world, only for themselves. Yes.
Keeping the ground realities of Pakistan and how the real estate property bubble is being created. So the equation MV is equal to PQ. You said that if M increases and then Q increases, it will not affect the P. But what about V, which is affected by the speculative investments in the bubble being created?
Yes, that's a very important, good question. If you look at Japanese growth experience, the miraculous jump, so one of the very important tools in their toolkit was directed lending. The private banks were given very carefully controlled patterns, that you are going to invest this much in that sector, this much in that sector, and they had to achieve those targets. So you prevent, so that is what's needed here also. If you allow, this is in the standard methodology, you just pump money into the system and let people invest where they will. This is what neoclassical orthodoxy tells you, because people will find the best return. So it is not true that the best return is, in fact, that is one of the Keynesian insights, that this investment is determined by gambling. So money will flow into the non-productive sectors. So you have to make sure that if you pump money in, it leads to production and not speculation. And that is a key insight of MMT also.
Sir, I'm just wondering why it's labeled as a theory, modern monetary theory, because the notions surrounding MMT, they have not been tested anywhere. So at best, it's a critique of the existing system.
I do not know who invented the terminology.
But Dr. Just to in further on that, from what I recollect now, the Congress government in India in the 90s had this minimum employment.
Yes, yes.
The minimum
Mahatma
employment
Gandhi
program.
rural
And
job
that
guarantee.
was something in line with what you have been saying, that they
Yeah.
were trying to create. That was, I think, for 120 days in a year or the 90 days in a year, a minimum employment guarantee was being given. A lot of money was being pumped in. So I think we can look at the effects of that. We have data available for that to look into it and
Yeah.
see whether it worked or didn't work.
Yes.
Although it was not across the entire economy,
Yeah.
but in one particular sector they did pump in a lot of money, and the government was running high fiscal deficits at that time in government. So I think it'll be good to see whether the results were what the MMT proposal suggests they would.
I have studied those results. The job guarantee programs have been tried in different places, and they have really yielded remarkable results. They have also been maligned and slandered by opponents, so it's always, when you read, you have to be careful. But in some places, they really have turned the economy around from a deep recession into growth. And a number of places they have been tried. So, including this Mahatma Gandhi Rural Job Guarantee Program, a lot of reports, good reports about it.
Gee, last question.
Sir, how do you think MMT can help a BOP constrained economy like the smaller open economy where people have more confidence